Good afternoon, everybody, and thank you all for joining us today. My name is Brendan Jetson, and I would like to welcome you to today's session on the Emerging Carbon Reporting Requirements in Australia, brought to you by LRQA. Before we go into the slides today, a little bit about LRQA and who we are. We are a risk and assurance company who operate in over 160 countries worldwide. Globally, we have decades of experience assuring assets and management systems, ensuring product integrity, delivering cyber resilience, and building responsible supply chain programs that will help you anticipate, mitigate, and manage risk. Prior to looking into the agenda today, some housekeeping. So just to make you aware, we will be recording this session for those who can't make it or who can't make the whole session. If you have any questions, please feel free to pop them in the chat and we will address these at the end where time permits, or if not, we'll address these after the call, or a webinar rather. Also, we'll be sending out a survey at the end of today's session. If you can do us a huge favor and complete the survey, it helps us to improve upon the content that we send out in the future. Looking at today's agenda, as part of what we're going to talk about, we'll be looking at the new regulations that are expected to come into Australia for FY 24-25 and what they mean for you. Some of the do's and don'ts around setting up a framework for carbon reporting, and also some of the supporting avenues that are open to you before we open the floor to a Q&A. Your speakers today, my name is Brendan Jetson and I'm the Strategic Account Manager for APAC. I've been working in the certification and verification industry for the last 8 years, and I'll be passing you now on to Katie to do an introduction and take the session forward.
Hi everyone, thank you so much for joining us today. My name's Katie. I'm a director in the Sustainability Consulting APAC team at LRQA. I've been in sustainability consulting, so working with corporate clients for over 10 years, and in the sustainability environment or in the sustainability space for more than 15, 16 years. And I help clients with a whole range of different sustainability related challenges, one of them being reporting and also climate change, climate accounting, carbon accounting, etc. I'm based in Singapore, and our client base from the APAC team ranges all the way across the Asia region, all the way through to Australia and New Zealand. Okay, great. So I'll be doing the first section of the session today. And the first thing we're going to talk about is these new regulations. So what do they mean to you? Before we dive into the regulations proper, I wanted to talk a bit about climate-related disclosures globally and regionally. So many of you may be aware that the climate-related disclosure ecosystem, it's still fairly nascent, it's still fairly new, but there are very rapidly reporting requirements are emerging all over the globe and being set by different market regulators. APAC is following, and certainly there are a number of APAC stock exchanges that have made or intend to make climate-related disclosures mandatory for their issuers. A majority of these exchanges are requiring issuers to report against international guidelines, such as the International Financial Reporting Standards and other international standards such as TCFD. Although climate-related reporting is still largely complex, and there's a lot of different standards out there, there is an acknowledgement that some standardization and streamlining needs to be done, and that's one of the things that we'll kind of mention during some of the next few slides. So what's driving these disclosure requirements? One of the first drivers for these emerging and increasing requirements for climate-related disclosure comes from stakeholders, especially investor stakeholders. So there's really an increased demand for both transparency and accountability from the corporate world, from companies, to disclose their climate-related and carbon-related activities. Like I mentioned, much of this comes from the investor space. Another big driver for these types of disclosure requirements is customer or client demand. The nature of scope 3 emissions, for example, being that covers individual companies' supply chain or value chain emissions, it's having a knock-on effect. So as one company is disclosing their scope 1, 2, and then 3 emissions, there's then a need for others down the value chain or either side of the value chain to additionally account for and disclose their own scope 1, 2, and then 3 emissions. There's also been an increase in priority of climate and emissions on the national agenda. So there's been more ambitious nationally disclosed contributions. Notably, Singapore, Australia, and New Zealand have all could all be considered to be have more ambitious nationally disclosed contributions. And then finally, it's not all external pressure. There are certainly some internal benefits or drivers for disclosing carbon and climate-related activities. This goes back to the old adage: you can't monitor what you can't manage what you don't measure. So better monitoring of these activities within your own organisation can only lead to a better understanding of your activities, where improvements can be made, and then benefits that could lead to improvements to your bottom line as well. So across these different markets, there are quite a number of similarities for carbon-related disclosure. I'll start with the EU. In all EU regulated markets, there is mandatory reporting requirements on carbon. And these cover scope 1, 2, and 3 of the emissions. Across the EU, the frequency of reporting is annual, so everyone needs to report annually, and there is external limited assurance mandated for these reports as well. So then moving to APAC, Singapore, Hong Kong, Bursa Malaysia, New Zealand all have mandated requirements for reporting on carbon for their listed companies. Some minor differences around the rollout of the requirements. So, for example, in Singapore, there are selected companies in a phased approach. In Hong Kong, all listed issuers need to disclose from 2025. In Malaysia, there's a slightly phased approach when it comes to main market versus ACE market. And then for New Zealand, currently, large financial institutions are targeted. There's also a slight difference in terms of the scopes that need to be disclosed. In Singapore, scope 3 is currently optional. That may change. Hong Kong, scope 3 is subject to materiality. So how material are your scope 3 emissions depends on whether you need to disclose or not. For both Bursa Malaysia and NZX, scope 3 is mandatory like the EU. And I'll come to Australia kind of comparison in just a second. All of these need to report annually, and assurance vary slightly as well, although most regulators mandate at least a limited insurance on the scope 1, 2, and some of the aspects of scope 3 emissions as well. So there is certainly a precedent for these upcoming requirements for the Australian market. So what are these? What's the kind of the process? What's the timeline for these? So the Australian Sustainability Reporting Standards are currently under development. These follow an issue or follow the IFRS standards for climate-related disclosure. So back in June 2023, the International Sustainability Standards Board issued the IFRS standards for climate-related financial disclosures. So the Australian standards are following on from these international standards. So in Australia, there was a Treasury consultation on the design of the new requirements, and the Australian Accounting Standards Board also issued a consultation on these climate-related financial disclosures over the last year. These consultations are wrapping up, and Q2 2024, the Australian Accounting Standards Board planned to issue the final climate-related disclosure standards. That then means a change in the amendments made to the Corporations Act, which will be implemented from the 1st of July 2024, which gives us about 6 months from now to prepare for these requirements and for mandatory reporting starting from Q3 onwards. These will also be rolled out in a phased approach, which I'll get to in a few slides' time to describe exactly when, who is required to report. There are benefits to disclosing against the ASRS, and hopefully these are some benefits that you will feel over time of reporting against them. So these reporting your climate emissions allows certainly for the identification of risks and opportunities. So by understanding your climate related activities, you can certainly identify where there might be risks to your business operations. Maybe there might be opportunities for your business as well. To make improvements to not only how you're operating, but also potentially to your products and services, etc. Reporting also allows benchmarking of environmental performance, so your environmental performance against your peers. So where do you sit in the market? And more importantly, probably comparison of your internal performance year on year. Are you improving year on year? Are you actually getting worse? And regular reporting allows you to monitor that and understand that, and then make improvements that will ultimately benefit your business and business operations. Reporting also allows you to keep up with these emerging trends that I've mentioned. It's certainly something that is an increasing expectation of corporates, outside of being regulatory mandated. But there's certainly an increasing trend for companies to be more transparent and accountable for their GHG emissions. And this increased transparency and traceability of the supply chain comes from the need to disclose your Scope 3 emissions. So understanding your supply chain allows you to identify improvements and improvements to your supply chain risks at the same time. Finally, satisfying investor demand and increasing business opportunity for consumers. No one's going to say they won't work with you because you disclose your carbon emissions. But on the flip side, there is a risk that investors, consumers, other stakeholders will have restrictions for who they work with based on things like carbon disclosure. So, what does this document look like? What can you expect from the ASRS? So these standards are still currently, we only have draft versions. As mentioned, that the final versions will be released later this year. But the draft versions we have come in 3 parts. The first is called the General Requirements for Disclosure of Sustainability Related Financial Information. This is essentially how you disclose your financially related, your climate related financial disclosures. So the scope of disclosure, what do you need to include in this disclosure? How do you present it? How do you structure it? The second is climate-related financial disclosures. This is the actual the data, the information that you need to disclose. And this is termed as risks and opportunities that could reasonably be expected to affect both for-profit and non-profit entities. And this is looking at your cash flow, access to finance, cost of capital, ability to further your objectives, etc. The third document is a reference document and a service standard that is updated periodically to reference relevant versions of other non-legislative documents that may be referenced in the ASRS standard. So specifically, what is this standard going to be asking for? Essentially, in a nutshell, they will request that companies report on their Scope 1, 2, and 3 GHG emissions on an annual basis. There will also be assurance requirements on these disclosures. So I'll dive into each of those aspects now. There's kind of 6 areas of the disclosure requirements. The first one focuses on materiality. So essentially, you need to decide what aspects of your carbon activities or GHG emissions are material for disclosure. So this is described as information is material if omitting, misstating, or obscuring it could reasonably be expected to influence decisions that the primary users of general purpose financial reports make on the basis of the reports. Bit of a mouthful, but essentially that there are materiality guidelines to how you can determine what is material for you to be disclosing. You also need to disclose governance processes, controls, procedures around monitoring and managing those climate-related financial risks and opportunities. There's also requirements to disclose your scenario analysis. I'm not sure if this is new terminology for people, but there are a number of different climate scenario analysis that will need to be done as part of this disclosure. This will start as a qualitative scenario analysis, and quantitative analysis will be something that increases, that will be required as the disclosures evolve. So currently, first year, certainly qualitative scenario analysis will be enough for your disclosures. Transition planning is another aspect of the report that will be required, and this is disclosing transition plans specifically around offsetting, target setting, mitigation strategies that you have put in place as a result of your scenario analysis and your reduction plans. You also need to disclose risk and opportunities for your entity in relation to carbon related activities, along with measures to assess and manage those risks and opportunities. And finally, the metrics and targets, which is your data. So this is the material scope 3 emissions, scope 1, 2, and 3 emissions data, including progress towards any internal targets you may have set, or if there are any regulatory requirements or statutory regulations, how you're progressing against those. So a couple of details here. Yes, the ASRS will require reporting of scope 1 and scope 2 emissions. Scope 3 emissions reporting will start from the second year of reporting. So not part of your first year, but certainly from your second year of reporting, you will need to disclose your scope 3 emissions. On the assurance side, there's a phased introduction of assurance of the data in the report. Starting straight away, there'll be reasonable assurance required for government disclosures and limited assurance for scope 1 and 2 for other companies. So that's just for scope 1 and 2 emissions. On the scope 3 side, there will be limited assurance required for the calculation methodology. So how you went about calculating your scope 3 emissions. There are expectations that assurance requirements will be increased and phased in over time. So as increasing years of reporting pass by. Also noted that reasonable assurance on government disclosures will be required later on in the timeline. So who needs to disclose? Not everyone needs to disclose from this year, starting this year. The standards mandate a phased approach. So larger companies will be targeted first. So 24-25 onwards will be larger companies of over 500 employees, gross assets of over $1 billion, and revenue of over 500 million. And companies will get smaller and smaller, or rather the requirements for companies will get smaller and smaller over the coming years. So where do you start? Sometimes this can be a little overwhelming for those companies who are new to this topic. Certainly scope 3 emissions accounting is one of the most challenging areas that companies find when they're starting out on carbon reporting journeys. So a very quick look at the definition. So scope 1 are emissions that are owned or controlled by the reporting company. So these are usually generated by the company itself. So things like the use of diesel and other fossil fuels. Scope 2 is usually the most commonly relevant emissions for companies, and this refers to purchased or acquired electricity, steam, heating, cooling, etc. This is usually the the biggest chunk for most companies. Scope 3, the most commonly understood by most companies. Scope 3 is actually usually the largest portion of the emissions. So these are indirect emissions that occur in the value chain of the reporting company. So these could be upstream emissions or they could be downstream emissions. As mentioned, this is probably one of the most challenging, the most challenging scope of emissions to calculate and account for. There are also various calculation options out there. There are certain guidelines that can help with determining your calculation methodology and actually doing the calculation. So the first thing we would always recommend companies to do is to start with identifying your scope 3 categories, which ones are relevant to you, which ones are most material to you, and then determining your calculation methodology. You could go from direct data, which means accessing your direct data from all your suppliers, for example, all the way through to average data. So averaging the data based on data that is already available out there. We usually recommend somewhere in the middle, collecting direct data from your most material value chain partners, and then averaging for the others. And then the third step is to go about collecting that data, calculating your emissions, and including that into your reporting. Setting targets is another area that is quite challenging for companies. You may have heard of science-based targets or the term net zero, and these are commonly used tools to allow you to set those reductions targets on your scope 1, 2, 3 and emissions and 3 emissions. So there's net zero standard, there's science-based targets. These are internationally recognized, and if you were to use these, that also supports your AS/RS reporting. Some tips for setting targets, really focusing on emission cuts. So where are the opportunities for some rapid, deep cuts to your scope 3 emissions? Then setting both near and long-term targets. That's also something that is that is allowed under the requirements. And then going beyond your value chain, where else can you go to look for target reductions to help increase your targets and ever more ambitious targets. I'm going to pass over to Brendan at this point to take the next section of the webinar.
All right, thank you for Katie. Put myself on mute. So I'll be talking through quality data reporting, some of the things that we've seen companies do to help them succeed, and some of the barriers that we've seen clients put in place that have actually hindered their progress with this aspect, and also looking at why it's important. So moving on to the next slide, when we look at why is it important, a lot of the people on this call, and one of the biggest hurdles we see in starting off with setting up a climate reporting framework is getting buy-in across the board. And it's very difficult to get buy-in across the board and have a successful system if you can't articulate and justify why different stakeholders within the business or the broader stakeholdership should be involved in setting up, investing time and money into this process. So the first point there is meeting your regulatory requirements. And as Katie mentioned, this is becoming more and more commonplace as voluntary schemes become mandated and mandatory across the globe. And where historically we had nice to haves, these are now must to haves. Maintaining your competitive positioning. And again, this reinforces what Katie was speaking to earlier. When you work with suppliers, when you work with tenders, when you work with your own partners, many of the procurement processes will now ask you, what are you doing in the space of social compliance, social improvement, environmental improvement, and with a greater focus and shift towards carbon emissions, what are you doing in this space? The relevance and importance of this is reflected in the fact that now 53% of ASX 100 companies are using third-party assured verification to showcase to stakeholders and investors that they can have confidence that they're working with a company that is investing in everyone's future and the planet's future. Of those 50, or of the ASX 100, I believe 91% are now reporting on climate reporting initiatives as well. Improving your resource allocation and decision making. So as you heard earlier, a climate data reporting goes beyond the traditional scope of what a management system and what a business looks at. Historically, we've focused inwards in terms of what we're looking at for continual improvement. What are our processes doing? How are they impacting our operations, and what are the risks associated with that? Climate data reporting takes you that next step in looking at your external stakeholders and the supply value, or the value supply chain, to understand where your risks are, where you're seeing large numbers of emissions, electricity generation, asking you also to forecast and look at the operational risks. So some of that scenario-based analysis that Katie was talking to, what happens if a power plant shuts down or if a coal mine shuts down? And that sort of extra focus will allow you to start making improved resource allocation, risk mitigation, and also a longer and more sustainable business future, and also a better and more sustainable planetary aspect as well. Building trust with our consumers and our investors. So a survey done last year by one of the research bodies showed that 85% of investors believe ESG accountability leads to better returns. And what that means is if you aren't investing into your ESG accountability and how you report on your initiatives in that space, you are 85% less likely to have those investors investing in you. That's a hugely powerful stat. That means only 15% of the investors would not consider this a differentiator. So it's becoming more and more critical from that perspective. From a consumer perspective, we are increasingly seeing a correlation between purchasing and an affiliation with a strong ethical message. So whether it's labour rights, environmental, social initiatives, the correlation between revenue and social initiatives is quite clear. Climate data reporting also adds that additional layer of governance to your processes. And one thing that is very important when looking at a climate data reporting system is not to treat it just as a compliance exercise, but also see it as an opportunity to build out and further flesh out your strategic initiatives. The more data you know and the more data you have, the better enabled you are to make decisions that will help improve your internal and external processes, and also evaluate who you work with. Last but not least is the contribution that you can make to our planet, the people around you, and the next generation. And that's not always talked about when we look at business initiatives, but it's something that should be first and foremost in everyone's mind. The next slide that I'll be talking to is looking at the best reporting practices and what we see companies that establish a very good reporting system do. And I've done this in a phased manner so you can kind of understand the process. And again, it speaks quite closely to what Katie has mentioned earlier. You want to start by understanding what your requirements are, what your business does, who are your stakeholders, what's important to your value chain, and what is most important to the success and sustainability of your business. And from there, establishing what your objectives are and what you'd like to achieve. You then need to go about articulating the benefits across all of your stakeholders. So externally, that might be the local community or your investors. Internally, it's not just your management team, but it's also embedding processes into your frontline workers, into your operational staff, and into your management teams so that they can understand why it's important to them to be part of this process, and making sure that it's not just another exercise that they have to tick on or tick off as part of their day-to-day activities. When you're adding in activities that are nominal and extra and seen not as part of people's normal everyday process, you're increasing the likelihood that they're not going to pay the same due diligence to those processes. Once you've got buy-in from the relevant stakeholders, the next step is determining, who will be responsible for what aspects of data input, data collection, data standardization, and the analysis of the collated information. And through that process, ensuring that there is a quality control mechanism throughout. Next up is conducting a gap assessment. And you can do this whether you have a new system or established system. What you really want to be doing is making sure that either internally or via a third party, you are always identifying where you have opportunities to improve, whether that be skill set, technology, methodology, anything that is coming into the market that can help further improve your system, you need to be setting this up before you set in motion the processes each year. We'd also strongly recommend using some of the frameworks that are out there. So GRI reporting and TCFD are the two most common standards that we see in Australia, both sitting at around 70% in terms of clients that use or report on climate data, use those frameworks. Use those frameworks as a starting point, but make sure they're relevant to you. So there's no point looking at a template that is used by the largest company in the world, because if you're a 50-person services company, your system may look very different to what other companies might look like. Once you've done a gap assessment and you're aware of what you would like to achieve and how you're going to go about it, you put the processes in place. Establish a process that is repeatable. So if the process isn't repeatable, it reduces the consistency in your approach, and that makes baselining your performance very difficult. It's very hard to say that you're improving or going backwards if you don't have a strong baseline to work off. You also need to look at ensuring that the process is repeatable, because it allows the correct analysis of data input, data quality, data monitoring, data analysis, and then also the reporting of that data to make sure that we're looking at the right trends, the right decision-making tools, and where we go from here. Once you've conducted all of these processes, we would strongly recommend verifying the system. Now, that can be internal if you wish. We would strongly recommend doing it externally as well. And the reason that we don't suggest just internal verification is, as we all know, when we're doing a process day in, day out, you start to become overly familiar with the process, and you don't always see some of the opportunities for improvement that someone coming in with a fresh pair of eyes might do. We also start to make logical leaps where there may be a gap because we know what the process is intended to do versus what is documented and set out. The verification piece is also highly important because it correlates with that confidence piece that we've spoken about earlier. So to ensure that investors and consumers are able to have confidence in the processes, the products, the services that you put out, that verification piece is a really strong way of marketing to the world that we are doing the best practice, we're adhering to it, and this is the proof that an industry expert has come in and said we are doing these things. 70% of investors actually stated in that same survey I referenced earlier that they believe carbon reporting initiatives should be mandated from a verification or external assurance perspective to ensure that there is confidence that these initiatives are being undertaken and enacted at the level that is being set out. The next slide here that I'll talk to is around the kind of an easy flow chart if you need to repeat this to your internal stakeholders. So have a gap assessment, look at your software, your methodology, the skill sets involved, your cultural alignment, what expertise you need that you don't have, what approach you're going to take and what methodology. Then operationally implement the outputs of the gap assessment, collect all your data and analyze it and make sure that you have the right reporting capabilities and also the skill sets to understand and analyze the data, and then transform that into something reportable and enable decision making from there. No point having the world's greatest data if you don't have the skills and the understanding to then use that as a strategic starting point for your next decision making phase. Once you've done all these steps, management and your experts will look at the results, they'll identify improvements, they'll recalibrate and set new benchmarks moving forwards, discuss these with stakeholders, implement any tweaks that they have to, and then verify and repeat. So a repeatable process, as we mentioned, is very important for consistency, baselining your measurement, bringing that external party, then showcase your success. There's nothing more important than going through all these steps and then showing to the world that you are doing the best possible thing you can do to make your business better and the surrounding and impacted societies better as well. Last but not least, we're going to talk about some of the pitfalls and things that we would suggest avoiding when considering setting up or evaluating your data reporting system. So unclear boundaries is a common one that we come up against. If you don't have clear and consistent boundaries, you may end up double counting or omitting emissions or misrepresenting your performance or impact. To avoid this, try and follow guidance from recognized standards or ask experts either internally or externally to help with this process. Another common pitfall is to use inaccurate or outdated data. So if you're not collecting data regularly enough, it's going to skew the efficiency of that data. If it's not accurate, then you're going to be making decisions on the wrong information, and that can set you up for failure. Poor stakeholder engagement is another one. You really need to make sure that everyone is invested in this process and that people are incentivized to do the right thing and to take this very seriously. We know that there are regulatory fines that are coming. We know that confidence in every business is impacted by its reputation. If you're making mistakes regularly, then that's going to impact on the bottom line and also your confidence from your stakeholders as well. We'd also suggest being cautious with a one-size-fits-all approach. So by all means, use templates, but make sure it's applicable to you. Make sure that when you look at a framework, it can be tweaked and adjusted to meet your processes, that it's something that you can actually achieve in a reasonable time frame, and you've got the skill sets to do so. Having continuous improvement is far better than having a system that doesn't achieve any of the results you set out to do. Limited validation and verification. Primarily there's a reluctance to do this because there's not always the right skill sets internally, and sometimes cost is used as a reason not to bring in experts to help verify. If you're not verifying your data, you are falling behind your competitors, and you're also opening up the possibility of the data being misrepresented or opportunities for improvement being missed. From a business perspective, you should also not look at this as another compliance exercise. The data sets that are opened up through climate data reporting are vast, and they can be used to help pinpoint a long-term sustainable and strategic decision-making process. If you're just using it as a compliance exercise, you're really missing a trick. Try and standardize your approaches as well, wherever possible. We find varying approaches and using suppliers' approaches and not your own, or having a vast array of different approaches to the collection or cleansing of data. It opens up the possibility that data sets aren't going to be consistent, and the greater the number of variances, the more difficult it is to make that data enactable. Last but not least, invest in your staff. So having all the right processes in place and a great software that does the reporting is fantastic. But if you're not investing in your staff to enable them to make the most of this process and to provide innovation at all layers of the business, both frontline, operationally, and at the management layer, you are not going to get the best out of your climate data reporting system, and that will impact on how beneficial the process will be for you. And I'll now pass you on back to Katie, who I think is going to run you through a case study of one of our clients who's done this very well.
Thanks, Brendan. Yes, so lots of great tips there on do's and don'ts. We worked with very recently with an Australian-based clothing manufacturer, and they engaged us to conduct data verification and assurance on their sustainability report, which include verifying their GRI indicators for GHG emissions and some other GRI indicators as well. So we did assure their scope 1, 2, and 3 carbon emissions. Some of the challenges we noticed or came across, or they came across when we were assuring their work was the variance across geographical locations. So climate change impacts vary across these different locations, which can cause a lot of challenges. You know, which numbers do you use, which boundaries do you set, etc. So localized assessment is usually required for effective risk management, but how do you manage that against the fact that so many businesses are sourcing very much internationally and from all across the globe? So looking at those localized risks and combining those with a global look, and making sure you're using the right emissions and factors, etc., for those global reaches, particularly with the scope 3 emissions. Quantifying impact is another challenging area and was something that this client came across. So quantifying these climate-related risks and opportunities, how to number that, right? So this was one of the the challenges that this client came across, and it could be one of the roadblocks in devising your resilient risk management systems. So look to the different methodologies that are out there, look to the different guidelines, look to your peers, look to consultants to help you with that type of that type of challenge, to make sure that you're using a methodology that is in line with the rest of the market and the required disclosure mandates. Brendan's covered this one pretty much, but accuracy and reliability of data is obviously one of the biggest challenges. They used to say that sustainability data was about 25% inaccurate. About 25% of sustainability data was inaccurate. I'm not sure the number for carbon data specifically, but certainly there is a lot of room for error in this kind of data, particularly depending on the calculation methodologies and the collection methodologies that you're using. So make sure you're aligning your data collection and your disclosure with projections in the capital market, so you can use some of these benchmarks and projections to help you to identify, are your numbers, do they look completely off, or are they looking like something that matches the rest of the market? And of course, external assurance is one of the best ways to ensure reliability and accuracy of that data, build trust with your various stakeholders, and align with some of the requirements that are out there. And of course, avoid greenwashing too, avoid accusations of greenwashing. So moving on to the final section of our presentation, then I believe we'll have a few minutes for questions, for Q&A. What's some of the support that you can look for when it comes to your reporting? There's plenty of early adopters out there. So under the DGSI yearbook, there are quite a few people or companies who are already reporting. They're using things like IFRS, GRI, TCFD, SASB, etc. So do look to these peers to see how they're reporting, how they're setting boundaries, what calculation methodologies they're using, how are they doing their climate analysis, what their transition planning look like, and that can give you an idea of what would be in store for you if you're just starting out on your climate journey and also your reporting journey. We can, of course, help you with both reporting and assurance. So in terms of getting to a reporting stage, we can certainly help you by, first of all, identifying that gap. So the gap that Brendan was talking about there, we can help you with this gap analysis, looking at the latest standards and best practices against your activities and see if there's any major gaps for improvement. We can also help you to, we can provide recommendations around best practices when it comes to bridging that gap. And we can also help you with some of the specific activities, such as collecting your scope 1, 2, and 3 data, developing the methodology for that, identifying what's material, where your boundaries are. And we can also help you with that scenario analysis and transition planning, target setting, etc. We can help you to draft reports and submit some reports, some versions for you to review, to go on to be published. And then we can also help excuse me, to provide high-level recommendations and to prepare for next submission. And then, of course, we can help you with the assurance. We can talk about kind of conflicts of interest if that's something that people want to discuss, but there are certainly ways that LRQA can support you with your preparing of your report and assuring a report. We just need to make sure there are walls that create independence between the two activities. But that is also something we can do. We can help you to provide comfort to your stakeholders internally and externally by conducting that external third-party assurance. Why LRQA? You probably know LRQA already for our name, our very good name in the certification assurance space. So we are one of the first certification bodies to be accredited against ISO, and we also hold a number of different accreditations, both worldwide and within the region. You may not know us so well for our consulting services, but we also have ESG consulting teams globally all over the world. As I mentioned, I'm in Singapore, so that's one of the teams in this region, and we can support on a whole range of different sustainability or ESG related challenges, particularly in scope today, which is the carbon reporting and accounting. So next steps, what do you do next? You can certainly visit our website for climate change related resources. There are a number of training courses that you can get involved in or join up to help you to understand where you need to go. And then also things like gap analysis, preparation of report, certification would be some of those next steps to get you started towards achieving the requirements against the new Australian reporting guidelines. So I think we're going to pause here to take some questions. So please do pop some questions in the chat so that we can answer any of those burning questions right now for you. Okay.
Sorry, Katie.
Okay,
There's actually one question that
sorry,
Brendan,
do you want to answer that?
So what's the question?
I can see a question on following this Australia specific regulation, does it give our company any advantage in the global market? I can take that question. Great question. If I can jump back a few slides to the ASRS regulations, give me a second to reach them. You'll see that these regulations, the Australian regulations, are very much in line, or they're based on other global internationally recognized standards and guidelines, specifically TCFD, so the Task Force on Climate-Related Financial Disclosures, which has been around for quite a while now, and also the new IFRS guidelines that came out last year that I mentioned. However, one kind of note or word of warning: if you report in line with the international guidelines, ISRS, you will be compliant with ASRS. So you will be compliant with the Australian requirements. However, if you report in line with ASRS, you will not be fully compliant with ISRS. So there are a few key differences between the IFRS requirements and the ASRS. Some of these, namely, are oh, sorry, I've lost my notes. Namely, that the ASRS will not incorporate requirements for an entity to consider the SASB standards, whereas IFRS does require this. ASRS applies only to reporting of climate-related financial information, whereas IFRS applies to all sustainability-related financial information. So there's a smaller scope for the Australian requirements. There's also a requirement for ASRS to determine there are no material climate-related risks and opportunities. So there is an opportunity for Australian listed companies to say that there's nothing material for them to report. However, IFRS does not have this corresponding requirement. So if you decide that you don't need to report against AFRS, that doesn't mean you don't need to report against IFRS. Finally, I think one other difference is that there are certain the scope of IFRS is also slightly different when it comes to the types of GHG emissions or climate-related emissions. For example, IFRS applies to all climate-related risks and opportunities, or all climate-related emissions, whereas ASRS doesn't apply to things like ozone depleting emissions, etc. So a long-winded answer, but I hope that answers that question.
Thanks, Katie. I think we've got another one here that was sent in a little earlier. So Australia has the NGR scheme for carbon reporting, and the person asking the question asked if these new requirements will be aligned with that scheme or if it's a separate scheme.
They are aligned, yes. I don't have the comparison quite as readily as I did the IFRS, but yes, there are certainly alignments to that scheme as well. So if you're using one that will certainly help you towards the ASRS as well.
Perfect. Another one that's been put in, which is a question we see quite a lot, is how long does it normally take to have a mature system implemented and report ready if you're starting from scratch?
To have a mature, to be fully ready, I think takes years and years, which is why there's a phased approach for a number of different aspects of this. That's why for year 1, you only need to report scope 1 and 2, and year 3 is then scope 3. It's also why the assurance requirements are phased. They only require you to assure scope 1 and 2 and scope 3 methodologies, because it is something that takes a while. It's not something you should expect to go from 0 to perfect overnight. It's certainly something that it could take years to get to a really mature point. However, to get to the point where you're ready to report, I think could take a few months. So I would say start now and you'd be ready for July.
Okay. Another question that we had come in a little bit earlier was, what are the penalties, or are there any penalties outlined in the draft regulations if companies don't comply with the new regulation?
I actually don't know the answer to that question. I will have to check on that and come back to it. But it's a listing requirement, so I imagine the penalties will be as aligned with other listing requirements.
Makes sense. Best to avoid it if you can anyway. Can LRQA help with scope 3 calculations?
Short answer, yes. Yes, this is certainly something we've helped a number of clients with over the years as part of the consulting team. And so, yes, we can help with setting the boundaries, determining what's relevant to you. We can help you to determine your calculation methodology. As mentioned, it can be quite varied. There can be different methodologies or different ways of calculating those emissions. So we can help you to identify or develop or determine the methodology that's right for you. We can then help you to put together things like data collection templates or accessing certain platforms in order to collect that data, and then helping you to do the calculations and putting that into a report. So all the way through from start to finish, we can help clients with. We can also help clients with the other aspects of the requirements, such as the scenario analysis and then transition planning, and also the target setting. So as mentioned, we've helped quite a number of clients now with their science-based target settings and submitting those targets to SBTi as well. So yes, we can help with all those different aspects of the report.
Perfect. I think there's one more question that's come in earlier, unless anyone would like to put their questions in before we wrap up today. So these changes that are coming through, are they legislated under the Corporations Act of 2001? Is that correct?
This will be the, yes, I believe so. Corporations Act, yeah, the most recent Corporations Act, that they'll be amended and implemented from the 1st of July 2024.
Perfect. Okay, I'll pause for 10 seconds in case anyone has thought of a last minute question to put in. Otherwise, we will wrap this up. So I'll silently count to 10. Okay, I think we'll wrap it up there. If there's any other questions, we will be reaching out to you via email just to follow up with any questions you might have if you're not comfortable sharing them in this open forum. We thank you very much for your time today. Thank you, Katie, for all your insights and expertise, and we look forward to you joining the next call.
Thanks so much for questions, everyone.